Welcome back to the Deep Dive. Today, we're jumping straight into something you sent us, Ken Mark's 25 Need-to-Know MBA Models.
Yeah, it's a great resource.
Our mission today is basically to unpack these 25 models, give you a clear rundown of each one. Think of it like a focused MBA briefing.
Exactly. And Ken Mark, he's got quite the background, right? CEO, finance director, worked at P&G, Harvard Business School, even wrote case studies for top schools. He really knows this stuff.
Yeah, he's seen it all.
And this book, it's aimed at, MBA students who need a refresher, managers without the MBA wanting a reference, even people thinking about an MBA. It's about making these concepts less intimidating.
I like how it's laid out, too. 5 main parts mirroring the MBA curriculum: change management, decision-making and people, marketing, strategy, and finance.
Right. And within each part, 5 key models, alphabetically.
Okay.
Plus, he talks about how they connect, which is useful.
And he's specifically focused on the general manager view, right? Firm-level stuff, not deep dives into macroeconomics or, like, basic stats.
Correct. It's about the tools you'd use running a business or a division. And he uses the term model pretty broadly: frameworks, concepts, tools.
It's about practical value, not strict definitions.
Precisely. So today, we're aiming for that comprehensive overview, kind of like a shortcut to understanding these core business ideas.
Okay, let's get into it. Part 1, change management. This is all about actually making change stick in an organization.
Yeah.
Getting beyond just routine.
Exactly. Moving the needle. And the first model is a big one, Kotter's 8-step model.
Ah, yes, Cotter. When would you typically use this one?
Well, it's designed for implementing significant organizational change. Think new structures, major IT rollouts, shifts in customer service approaches, that kind of thing.
And where did it come from? Is it just Cotter?
Well, the idea of managing change isn't new. Consulting firms were working on it post-war, but it got more formalized in the 80s and 90s. Kotter's model is probably the most famous, but there are others like Jansen's 4 Rooms of Change or Cantor's Change Wheel. But Kotter's is very people-focused. It's about getting employees to actually adopt new work patterns, new attitudes. It's not just about flipping a switch.
Right, it's the human element.
Yeah.
So what are those 8 steps? They have to be in order, don't they?
Yeah. Kotter emphasizes the sequence. Step 1, create urgency. People need to feel why change is necessary. Mark mentions Stephen Elop's burning platform memo at Nokia back in 2012. Pretty stark example.
Wow, yeah. Okay, urgency first, then.
Second, form a powerful coalition. You need key people, influential people driving this change. Can't be a one-person show. Third, create a vision for change. What does the future look like? Make it clear, make it compelling.
Got it. Urgency, coalition, vision. What's number 4?
Fourth, communicate the vision. And communicate it a lot. Use different channels. Make sure leaders are explaining it to their teams, constantly reinforcing it.
Okay, makes sense. Keep beating the drum. What's after communication?
Step 5, remove obstacles. Find out what's blocking the change. Could be old structures, resistance, policies, and tackle them head on.
Right, clear the path.
Then, step 6, create short-term wins. Change is often a long haul. People need to see progress along the way to stay motivated. Celebrate those early successes visibly.
Quick wins. Good for morale. What about the last 2?
7, build on the change. Don't declare victory too early after the first wins. Analyze what's working. Use that momentum to tackle bigger challenges. Keep pushing.
Don't let up.
And finally, 8, anchor the changes in corporate culture. Make the new ways the way we do things around here. Embed it in stories, promotions, training, hiring. Make it stick.
So it's pretty comprehensive roadmap. How do you actually use it day to day?
Well, you adapt it, obviously, it's not rigid, but Mark's big tip is about the emotional side. You have to help people see and feel the change, connect with it emotionally. It's not just logic.
That's a great point.
Yeah.
Any pitfalls to watch out for?
The main one is that it's really designed for top-down change. If you don't have strong leadership buy-in, or if the change really needs to bubble up from below, Kotter's model might not be the best fit. It assumes leadership is driving.
Okay, good to know. Let's shift gears to part 2. Decision-making and people. This is about how we choose things, how we work together, right?
Exactly. And the first model here is super interesting: cognitive biases in decision-making. Basically, how our brains can trick us.
Yeah, I find this fascinating. Where did this idea come from?
A lot of it stems from the work of Amos Tversky and Daniel Kahneman back in the 60s and 70s. They really challenged the old rational choice theory, the idea that we always make perfectly logical decisions.
Right, the Homo economicus idea?
Exactly. They showed we use mental shortcuts, heuristics, which are useful most of the time but can lead to systematic errors or biases, like how framing something as a potential loss versus a potential gain totally changes how risk-averse we are.
So it's not rational. What are some common biases we should know about?
Oh, there are loads. Mark mentions things like groupthink, where everyone wants to agree, so critical thinking goes out the window.
Hmm.
Or representativeness, where we judge something based on how well it fits a stereotype, ignoring the actual odds. Then there's things like illusory correlation, seeing connections that aren't there, memory biases like consistency bias, where we misremember our past views to match our current ones, motivational ones like egocentric bias, where we overestimate our own role, and framing, which we just mentioned, how context shapes our choices.
It sounds like we're walking minefields here. How can we actually use this knowledge?
Well, the first step is just awareness. Knowing these biases exist in you and others. Then you can actively try to counter them, like in a meeting about a new product.
Yeah.
Actively look for reasons it won't work, to fight confirmation bias. Or when negotiating, be aware of the first number thrown out that's anchoring bias trying to set the tone. Kahneman suggested having everyone write down their initial thoughts before a discussion starts.
Oh, that's smart. Stops the first speaker dominating.
Exactly. It prevents that early anchor or groupthink dynamic.
Are there downsides to trying to spot biases everywhere?
Yeah, two main pitfalls. One is analysis paralysis, getting stuck trying to de-bias every tiny decision. The other is, well, it's way easier to see biases in other people than in ourselves, isn't it?
Yeah, definitely.
So seeking feedback on your own thinking is really important. Hard, but important.
Okay, moving on. Next up is emotional intelligence, or EQ. Seems like this is everywhere now.
It really is. The term itself was coined around the mid-'80s, but it builds on earlier ideas about social intelligence. Howard Gardner's multiple intelligences theory in the '70s also paved the way. But Daniel Goleman really brought it mainstream in the mid-'90s.
And what is it, fundamentally?
It's basically the ability to monitor your own emotions and other people's emotions, understand them, and then use that understanding to guide your thinking and actions effectively. It's crucial in the workplace, especially for leaders, sensing how others feel, being aware of your own impact.
Goldman broke it down into components, didn't it?
Yes, 5 key ones. First, self-awareness. Knowing your own emotions, strengths, weaknesses, what drives you, your values, how you affect others. It's the foundation.
Okay.
Second, self-regulation. Controlling those disruptive impulses. Thinking before you act, staying calm under pressure. Third, internal motivation. Being driven by purpose, by achievement itself, not just money or status.
Right.
Fourth, empathy. Understanding others' emotional states, seeing things from their perspective. And fifth, social skills. Managing relationships, building networks, finding common ground, inspiring people.
That's a powerful set of skills. How can you use this framework?
You can use it informally, just reflecting on yourself against those 5 areas. Where are you strong? Where could you improve? Or more formally, organizations use EQ assessments for hiring, promotions, leadership development. It gives a structured way to look at these softer but critical skills.
What's a good practical tip for boosting your EQ?
Mark suggests getting multiple perspectives. Since our self-perception can be skewed, things like anonymous 360-degree feedback or group coaching where people give honest input can really highlight blind spots.
Makes sense. What are the pitfalls?
Thinking the assessment is the end point, it's not. That's where the real work of change begins. And trying to do it alone is tough. Having support, a boss, a mentor, a coach makes a huge difference.
Okay, next model. Negotiating techniques, and specifically BTNA, best alternative to a negotiated agreement.
Ah, yes. Straight out of Fisher and Urey's classic Getting to Yes, your BTNA is your walkaway option. What will you do if this deal doesn't happen?
So it's your plan B.
Exactly. It's absolutely crucial for negotiation power. If you don't know what you'll do if you walk away, you're negotiating blind. And it's not always obvious. Say you're launching a new product and negotiating with a big supermarket chain.
Yeah.
Your BTNA might be selling online instead, or going with a smaller chain, or maybe even delaying the launch. You have to think through all the alternatives, including non-financial stuff like reputation.
So how do you figure out your BTNA?
Fisher and Urey suggest a process. 1, list all the things you could possibly do if no deal is reached. 2, improve the most promising ideas, make them more realistic. 3, tentatively pick the single best one. That's your BATNA.
And it's not the same as a bottom line.
Right. The bottom line is often rigid. Your BTNA gives you flexibility. It's the standard against which you measure any proposed agreement. Is this deal better than my BATNA? If yes, consider it. If no, walk away or keep negotiating.
What's the top tip here?
Don't get locked into just one course. And always try to understand the underlying interests of both sides, not just their stated positions. Your BAP&A helps you protect your interests.
Okay, last one in this section. 360-degree assessment. We mentioned this briefly with EQ.
Yeah, it's a common tool now. The basic idea of getting feedback from multiple sources is old. Mark even mentions ancient Chinese rating systems and the German military in WWII.
Really?
Yeah, but the modern version, with anonymous surveys and coaching, was really developed from the 1950s onwards. Clark Wilson was a key figure. DuPont used it early on in the 70s, and it became widespread by the 90s.
And the core idea is?
Getting feedback on your performance and behaviors from, well, 360 degrees around you.
Yeah.
Your boss, your peers, people who report to you, sometimes even customers or clients. Usually done via anonymous surveys, often with rating scales and open-ended questions.
How does it typically work?
Usually the person being assessed helps identify the reviewers. The surveys go out, HR or a consultant compiles the results into a report, keeping it anonymous. Then, crucially, the person discusses that report with a manager or coach to understand the feedback and create a development plan. Many places do it regularly to track progress.
What's key to making it work well?
Mark stresses thoughtful implementation, especially the first time. Maybe get external help to ensure anonymity and trust. That anonymity is vital for honest feedback, especially from subordinates and peers.
And the pitfalls. What can go wrong?
A big one is the manager's reaction. If the feedback is, well, surprising or critical, they might get defensive or try to figure out who said what. A total witch hunt is disastrous for trust.
Yeah, that would kill it.
And the other pitfall is just ignoring the results. Even if you disagree, those perceptions are people's reality and they affect how they interact with you. You have to engage with it.
Okay, let's move into part 3. Marketing. Mark frames this as seeing the world through the eyes of the customer, mixing old and new ideas.
Exactly. Balancing classics like the 4Ps with newer stuff like segmentation and multi-channel approaches. First up is multi-channel marketing.
This isn't exactly new, though, is it? Catalogs in stores?
No, not at all. Sears catalog from 1894 is a classic example. But managing multiple channels became a much bigger deal with professional supply chains. A key challenge used to be selling direct and through retailers without upsetting your partners.
Channel conflict.
Right. Now it's often more about the customer using multiple channels, researching online, buying in-store, getting support via chat. It's about using multiple routes simultaneously to reach more people or maximize profit, and increasingly providing a seamless experience across those channels.
So what does good look like here?
Consistency is key. Consistent message, consistent experience, whether they're on your website, app, in person, or calling support. And pooling customer data, getting that single view of the customer across all their interactions.
Well, it's a practical tip.
If you use intermediaries, distributors, agents, retailers, remember, you need strategies for them too, not just the end customer. They're part of your channel ecosystem.
And the pitfall.
Thinking that just being everywhere is multi-channel. It's not. You need focus. Which channels do your target customers prefer? And how do you make the experience smooth between those preferred channels?
Okay, next. The classic 4Ps of marketing. Product, price, place, promotion. Every intro marketing course covers this.
Absolutely foundational. Goes back to Neil Borden's marketing mix in the 60s. Then Jerome McCarthy simplified it into the 4Ps, and Philip Kotler really popularized it. It's the core toolkit for bringing something to market.
When would you use it?
Anytime you're launching something new or reviewing your current strategy or even analyzing competitors, you systematically think through each P.
So recap the Ps for us.
Sure. Product. What are you actually selling? Features, quality, design, brand, packaging, price, how much does it cost? Consider value, costs, competitors, place. How does it get to the customer? Distribution, logistics, online, offline. Promotion, how do you tell people about it? Advertising, PR, social media, sales efforts.
And the key is making them work together.
Exactly. They need to be aligned. A premium product needs a price and distribution channel that reflect that premium quality and promotion that targets the right audience. Consistency is crucial, especially now with online targeting giving customers so much info.
What's a common mistake people make with the 4Ps?
Taking it too literally, especially online. Just sticking a paper brochure online isn't good digital marketing. Or thinking only in terms of short-term promotional campaigns instead of building longer-term value and relationships. It's bigger than just ads.
Right. Okay, let's talk pricing strategy. This seems like both an art and a science.
It really is. It draws from microeconomics, finding that optimal price, but gets complicated in the real world. Different customers willing to pay different amounts, prices changing over time, competitor reactions. Game theory comes in here too, and the internet with dynamic pricing has changed the game again.
So much data now.
Exactly. More data, more transparency. So, what is pricing strategy? It's finding the price that meets your profit goals, aligns with customer demand and willingness to pay, and considers the competition.
Mark outlines 5 main models.
Yeah. Cost plus. Calculate cost, add margin. Simple, but ignores value and competition. Competitive, price relative to competitors. Common, but can lead to price wars. Value-based, price based on perceived customer value. Good for innovative products. Psychological, using price points like 9.99 taps into perception. Dynamic, prices change based on real-time demand. Think airlines, hotels, enabled by online data and pricing bots.
How do you choose? How
Yeah.
do you use them?
You need to understand your costs, your demand curve, and what competitors are doing. For dynamic pricing, you need lots of data past demand, future forecasts, competitor prices, available capacity.
Top practical tip for pricing.
Understand what your customer is willing to pay first, what's the value to them, then work back. Sometimes, surprisingly, charging more can actually increase the perceived value, especially for luxury items.
Interesting. Okay, next is segmentation and personalized marketing.
Yeah.
Cutting the market into pieces.
Precisely. The idea that you can't treat everyone the same goes back to Wendell Smith in the 50s. Markets are heterogeneous. Then others built on it, finding groups with common characteristics who respond similarly to marketing. It's moved from mass market to targeted segments and now towards one-to-one personalization.
What's the difference?
Segmentation is dividing the broad market into smaller, distinct groups with different needs or characteristics. Personalized marketing is taking that to the extreme, tailoring the offering, potentially uniquely for each individual customer.
How do you actually do segmentation?
It's a process. 1. Define the market you're playing in. 2. Gather data, geographic, demographic, income, lifestyle, behavior. Online data is huge here now. 3. Analyze the data, often using clustering techniques to find groups with similar attributes. 4. Identify and profile the most promising segments, give them names, understand them deeply, and then develop tailored strategies for each one.
And the tip here.
Be creative. Don't just use the obvious demographic splits. Think about needs, attitudes, behaviors. Finding a unique way to segment the market can help you avoid direct competition. Mark uses the SUV example in cars. It wasn't just a demographic, it was a lifestyle and needs-based segment that exploded.
Right, creating a new category almost. And we should also mention the product life cycle here, even though it's not a full chapter.
Absolutely. It's fundamental. Products go through introduction, growth, maturity, decline. Knowing where your product is helps decide everything from pricing to marketing spend to R&D focus. It underlies a lot of marketing strategy.
Okay, fantastic overview of marketing. Let's move to part 4. Strategy. The big picture stuff. Where are we going? How do we win?
Exactly. Where to play and how to play. Mintzberg identified like 10 schools of strategy, but Mark focuses on 5 well-known ones dealing with competition, internal strengths, managing multiple businesses, and finding new markets.
First up, the BCG growth share matrix. The classic stars, cash cows, question marks, dogs.
That's the one. Developed by Boston Consulting Group, really popular in the 70s and 80s when diversification was big. It's a simple 2x2 grid for mapping a company's portfolio of businesses.
Remind us how it works.
Vertical axis is market growth rate, how fast the whole market is growing. Horizontal axis is relative market share, your share compared to your largest competitor. You plot each business unit as a circle. Size represents sales volume.
Yeah, the quadrant.
Stars, high growth, high share, need investment to fuel growth, question marks. High growth, low share, risky, need investment to gain share or divest. Cash cows, low growth, high share, generate lots of cash, milk them. Dogs, low growth, low share. Often drain resources, consider divesting. Growth equals market attractiveness, share equals business strength.
How did companies use it?
Primarily as a tool for corporate HQ to decide where to allocate cash and resources across the different businesses. Feed the stars, figure out the question marks, milk the cows, get rid of the dogs. Simple prescription.
But maybe too simple.
Often, yes. That's the practical tip. Don't follow it blindly. Market attractiveness is more than just growth. Market share definitions can be tricky. What if you're a niche leader?
And the pitfall.
It can become a self-fulfilling prophecy. Label something a dog or cash cow, starve it of investment, and surprise, surprise, it declines. It ignores potential synergies, too. Its popularity has waned a bit as focus shifted.
Okay, next strategy model. Blue ocean strategy. This sounds more appealing than dogs and cows.
Yeah. It's about creating new market space, uncontested blue oceans instead of fighting bloody battles in existing red oceans. The goal is to make the competition irrelevant by creating a leap in value for buyers.
How do you find a blue ocean?
It's about looking beyond existing industry boundaries. You use a strategy canvas to map your offering against competitors based on factors the industry competes on. Then you ask, what factors can we eliminate that the industry takes for granted? What can we reduce way below the standard? What should be raised way above? And crucially, what can we create that the industry has never offered?
That sounds like it requires real innovation.
It does. It's called value innovation, pursuing differentiation and low cost simultaneously, breaking that trade-off. The tip is to look for insights in weird places, use diverse teams, ask, what would a disruptive thinker do here?
And the catch.
True blue oceans are rare. Many attempts end up being mirages or just small niche markets. It's hard to genuinely create uncontested space.
Makes sense. Okay, shifting focus inward now. Core competence and the resource-based view.
Right. So if Porter's 5 forces, which we'll get to, looks outside, this looks inside. In the 90s, focus shifted towards understanding why some firms are more profitable than others, even in the same industry. The answer, according to this view, lies in unique internal resources and capabilities.
Resources and capabilities. Like what?
Resources are assets, brand, patents, relationships. Capabilities are what you do with them. Processes, skills, culture. Core competence is a specific capability, a deep-seated skill that allows you to deliver unique value. It's more applied than the broader resource-based view.
So how do you identify your core competencies?
You look for resources and capabilities that are valuable, help exploit opportunities or neutralize threats, rare, few competitors possess them, inimitable, hard to copy, and organized. The firm is set up to exploit them. That's the VRIO framework implicitly.
Yeah.
You brainstorm what customers value, inventory your resources and capabilities, assess them against VRIO, and identify potential core competencies.
What's the practical takeaway?
The strict definition of a core competence is quite exclusive. Mark suggests using the VRIO criteria more loosely as a way to think critically about what truly differentiates you, where your strengths lie, and how sustainable they are against competitors, sharpening your edge.
Okay, back to the external view. 5 forces analysis. Michael Porter again.
Yes, arguably Porter's most famous framework from the late 70s. It's designed to analyze the overall attractiveness, meaning the average profitability of an industry. It looks at the competitive structure.
And those 5 forces are?
1. Rivalry among existing competitors. How intense is the competition between current players? Lots of players, slow growth, high exit barriers mean high rivalry. 2. Threat of new entrants. How easy is it for new companies to enter the market? Low barriers mean high threat. 3. Threat of substitute products or services. Can customers meet their needs with different types of offerings? High threat limits pricing power. 4. Bargaining power of suppliers. How much power do suppliers have to raise input prices? Few suppliers, high power. 5. Bargaining power of buyers. How much power do customers have to drive prices down? Many suppliers, few buyers mean high buyer power.
How do you use this analysis?
First, understand the current state. Assess the strength of each force, maybe use pluses and minuses. Where's the pressure coming from? Second, brainstorm ways your firm can improve its position by, say, reducing buyer power, differentiation, or raising entry barriers. Patents scale.
What's a key tip for doing this well?
Mark says, check your analysis against reality. Compare your industry's average profitability to the overall economic average. If your industry is way below average, you know those forces are strong. If it's way above, the forces are likely weaker.
Okay, final strategy model. Game theory, focusing on the prisoner's dilemma. This sounds mathematical.
It has roots in math, yeah, John von Neumann back in the 20s. But it's really about strategic decision-making when outcomes depend on others' choices. Think oligopolies, pricing decisions, negotiations. Your price isn't just about costs and customers, it's about how competitors might react.
And the prisoner's dilemma illustrates this.
It's the classic example. 2 suspects are arrested, interrogated separately. If both stay silent, they get a short sentence. If one confesses and the other stays silent, the confessor goes free. The silent one gets a long sentence. If both confess, they both get a medium sentence.
Right, so the best collective outcome is both stay silent.
Yes, but individually, each prisoner reasons. If the other stays silent, I'm better off confessing. Go free versus short sentence. If the other confesses, I'm still better off confessing. Medium sentence versus long sentence. So, confessing is the dominant strategy for both, leading to a worse outcome for both than if they'd cooperated.
How does this apply to business?
Think about price cuts. Cutting your price might boost your sales if competitors don't react. But if they do react by cutting their prices too, everyone just ends up with lower margins. Game theory helps you think through these if they do X, I should do Y scenarios.
So how do you use it?
You try to map out the choices and payoffs for you and the other players, a payoff matrix. Look for dominant strategies, always the best choice for you, and dominated strategies, always worse than another choice. See if you can predict the likely outcome or find ways to change the game, maybe through communication or commitment.
What's the practical advice here?
The core principle, anticipate competitors' reactions, is widely useful, even without complex math. Just drawing a simple payoff matrix can clarify thinking for promotions, bidding, etc. And the pitfall.
Misjudging your opponent, either underestimating their strategic thinking or, conversely, overestimating it and assuming perfect rationality when they might act unpredictably. Mark mentions the UK 3G mobile license auction, where companies massively overpaid a result of complex bidding game dynamics gone wrong.
Okay, that wraps up strategy. Now for part 5. Innovation and entrepreneurship. New ideas, new ventures.
Yep, exploiting new ideas commercially, innovation, and pursuing opportunities resourcefully, entrepreneurship. Emphasis on newer models like lean startup, design thinking, disruptive innovation.
Let's start with design thinking. We hear this term a lot now, often linked with companies like IDEO.
Exactly. It's an approach to innovation that's very human-centered. It borrows from the designer's toolkit, empathy, creativity, experimentation, prototyping. It blends analytical thinking with intuition. Roots go back to Herbert Simon, industrial design, but IDEO's David Kelly, Tim Brown, Roger Martin really brought it into business strategy.
How is it different from, say, traditional R&D? It's less linear, more iterative. It starts with deep empathy for the user, understanding their unmet needs, often through observation, like anthropology. Then it involves generating lots of ideas, building quick and dirty prototypes to test assumptions, and refining based on feedback. It's solution-focused, comfortable with ambiguity, embraces failing fast to learn.
What are the key traits of a design thinker?
Mark lists empathy, optimism, believing a solution is possible, experimentalism, testing ideas, and collaboration, working across disciplines.
And the process.
Generally, it follows steps like 1. Define the problem deeply from the user's view, lots of why questions. 2. Create and consider many options, divergent thinking, diverse teams. 3. Prototype and test, then refine, convergent thinking, rapid iteration.
Okay, sounds very hands-on. Next, disruptive innovation, Clay Christensen's famous theory.
Yes, hugely influential. Christensen distinguished between sustained innovation, making good products better for existing customers, which usually helps incumbent leaders, and disruptive innovation.
And disruptive innovation is?
It typically starts by offering a simpler, cheaper, or more convenient product to overlooked customers at the low end of the market, or creates a new market entirely. Initially, the quality might be lower than mainstream products, so established leaders often ignore it.
Until it's too late.
Exactly. The disruptive innovation gradually improves, moves up market, and eventually displaces the established technology or business model. Think digital cameras versus Kodak, or maybe even simpler electronic banking versus complex traditional banking initially. The established players are often trapped by their focus on current high-profit customers.
So how should big companies deal with potential disruption?
They need to scan the horizon for emerging technologies, even if they look niche or low quality initially. Consider investing in them, maybe through separate business units that aren't constrained by the main company's processes or profit expectations. Give them autonomy to pursue the new, potentially disruptive model.
Interesting. Okay, next is the lean startup. This seems like the dominant model for tech startups now.
It really is. Emerged over the last decade or so, heavily influenced by Silicon Valley. It's a reaction against writing huge business plans upfront and building a full product before getting customer feedback.
So what does it advocate instead?
It's all about speed, learning, and iteration. The core is the build, measure, learn feedback loop. Focus on validated learning, proving your assumptions with real customer data, not just guessing. Use iterative product releases and be prepared to pivot. Make a fundamental change to your strategy based on what you learn.
How does that loop work in practice?
1. Start with your idea. Turn it into a testable vision with specific hypotheses. Universal customers will pay X for feature Y. 2. Build a minimum viable product, MVP, the simplest version possible that allows you to test a key hypothesis. 3. Measure how customers use the MVP. Get feedback. 4. Learn from the data. Did it validate your hypothesis? If yes, persevere and iterate. If no, pivot. Mark uses the Rent the Runaway example. They tested demand by letting students try on dresses in person before building a website.
Smart. Okay, next model. Open innovation, moving beyond internal R&D.
Right. The idea that not all the smart people work for you. Historically, companies kept R&D very closed, proprietary. Open innovation, championed by Hank Chesbrough, recognizes that good ideas and technologies can come from outside customers, universities, suppliers, startups, even competitors. And sometimes it makes sense to share your IP, too.
So it's a two-way street.
Yes, bringing external ideas in, outside in, and letting internal ideas go out, inside out, perhaps through licensing or spin-offs. Think P&G's Connect Plus Develop program, Lego ideas where fans submit designs, app stores built on open platforms, crowdfunding. Lots of examples now.
How do companies actually do this?
It requires a mindset shift. Embrace partnerships, collaborations, crowdsourcing. Be willing to accept that innovation doesn't have to originate internally. The value might come from speed or combining technologies or building services on open platforms.
Okay, final model on this section. Scenario planning, looking at possible futures.
Yeah, this one helps deal with long-term uncertainty. Instead of just extrapolating current trends, which is often wrong, scenario planning develops a few distinct, plausible future scenarios to explore potential threats and opportunities. Royal Dutch Shell famously used this in the late 60s, early 70s, inspired by military planning, and it helped them anticipate the 1973 oil crisis.
How does it work?
1. Identify major trends affecting your industry. 2. Separate them into predetermined factors, things likely to happen, and critical uncertainties, things that could go different ways. 3. Focus on the 2-3 most critical uncertainties. 4. Create a framework, often a 2x2 matrix using 2 key uncertainties, defining 4 possible scenarios. Give them memorable names. 5. Describe what each scenario would look like and its implications for your business. 6. Use these scenarios to test your current strategy and inform future decisions, R&D priorities, etc.
What's the hardest part?
Mark says identifying those key uncertainties is the most difficult but crucial step. Getting those right determines how useful the whole exercise will be.
All right, okay, that's innovation. We've reached the final part, part 6, finance, the language of business.
Indeed. Finance provides the tools to measure performance, make investment decisions, and communicate with capital providers. We'll cover capital budgeting concepts, investor analysis, and valuation.
First up, the capital asset pricing model, CAPM. Sounds technical.
It is a bit, but fundamental for understanding risk and return for investments, especially stocks. Developed by William Sharpe, building on portfolio theory. It estimates the return investors should expect for taking on the risk of holding a particular asset.
How does it calculate that expected return?
The formula is expected return, risk-free rate, plus beta, expected market return, risk-free rate.
Okay, break that down.
The risk-free rate, RF, is the return on a theoretically risk-free investment, like a government bond. Beta measures how volatile the asset is compared to the overall market. A beta of 1 means it moves with the market. 1 is more volatile, 1 is less volatile. The expected market return, RF part, is the market risk premium, the actual return investors expect for investing in the market overall versus the risk-free rate.
So beta is key.
Yes, it quantifies the asset's systematic risk, the risk you can't diversify away. CAPM says you should only be compensated for bearing systematic risk.
What's the practical tip here?
Understand the limitations. Beta is usually calculated based on past volatility, but the future might be different. The model makes assumptions that don't always hold perfectly in the real world.
Got it. Now, capital budgeting and discounted cash flow weren't separate chapters, but they're mentioned as key.
Absolutely essential. Capital budgeting is how firms decide which long-term projects to invest in. Simple methods like payback period, how long to recoup cost, exist, but they're crude. The core is discounted cash flow, DCF analysis.
Which includes NPV and IRR.
Exactly. Net present value, NPV, calculates the present value of all future cash flows from a project, minus the initial investment. If NTV is positive, the project should add value. Internal rate of return, IRR, calculates the discount rate at which NPV equals 0, essentially the project's effective rate of return. You compare IRR to your cost of capital. DCF recognizes the time value of money. $1 today is worth more than $1 tomorrow.
Okay, next. Ratio analysis, using financial statements to understand performance.
Right. Taking numbers from the balance sheet, income statement, cash flow statement, and calculating ratios to compare performance over time or against competitors or industry benchmarks. It started getting used systematically by banks in the late 19th century U.S. to assess lending risk.
What kinds of ratios are there?
Mark groups them into 4 categories. 1, profitability. How well does the firm generate profit? e.g. return on assets, return on equity. 2. Operational efficiency. How well does it manage operations, e.g. inventory turns, days sales outstanding. 3. Liquidity. Can it meet short-term obligations, e.g. current ratio, quick ratio. 4. Leverage or solvency. How reliant is it on debt, e.g. debt to equity interest coverage ratio.
How to use them effectively.
You need context. Compare ratios over several years to see trends. Compare them to industry averages. Mark shows a table comparing 3 firms. Firm B looks strong on liquidity and efficiency even with lower revenue than Firm A.
Top tip.
Calculate multiple ratios for a rounded view. Ratios don't give definitive answers. They highlight questions that need further investigation. Why is our inventory turnover slowing down? Why is our competitors' ROE higher?
Okay, that leads into valuing the firm. How much is a company actually worth?
The million-dollar question. Sometimes, literally, there's no single right answer. Value depends on the method and assumptions. DCF principles actually trace back centuries. Mark shows 4 common techniques.
What are they?
1. Asset-based, based on balance sheet assets minus liabilities. Book value, often a floor value. 2. Comparable transaction. Look at what similar companies recently sold for using multiples like EBITDA multiples. Gives a market-based range. Mark's luxury desserts example gets $3.02 as $4.03 right here. 3. Discounted cash flow, DCF. Project future free cash flows, discount them back to present value using the cost of capital. Includes estimating a terminal value. This gives $4.38 in the example. 4. Dividend discount model. Value based on the present value of expected future dividends. Often uses the Gordon growth model for stable firms. Gives $3.63 in the example.
So you get a range of values.
Exactly. The luxury desserts example yields $2.04 asset base to $4.04 DCF comps. The analyst then needs to weigh the methods, consider subjective factors, management strength, brand, and external factors, market conditions, competition, plus why the seller is selling.
What's a practical tip?
Use several techniques. Triangulation gives a better picture. Understand what drives each valuation. DCF is very sensitive to growth and discount rate assumptions.
And the pitfall.
Believing the calculation is the answer. Garbage in, garbage out. Be super critical of your own assumptions, especially things like the long-term growth rate in a DCF.
Right. Final model, weighted average cost of capital, WACC. This sounds important for DCF.
It is. WACC is the average cost of all the capital a company uses, both debt and equity weighted according to the proportion of each. It's the blended rate of return the company needs to earn to satisfy all its investors. The theory developed through work by Modigliani and Miller and others in the 50s and 60s.
How do you calculate it?
The formula is WACC, equity total value, cost of equity plus debt total value, cost of debt, 1 tax rate.
Okay.
You need the market values of equity, E, and debt, D. The total value, V, B plus D. The cost of equity, RE, often from CAPM. The cost of debt, or under the interest rate, adjusted for tax savings because interest is tax deductible, hence the 1TC factor.
How is it used?
Primarily as the discount rate for NPV calculations and capital budgeting. It represents the minimum return a project needs to earn to create value for the firm's investors. Mark calculates a WACC of 21.6% for his Griffin conglomerate example.
What's the key practical point?
WACC is the hurdle rate. Projects need to clear this hurdle to be worthwhile.
And the pitfall.
Calculating the cost of equity estimates the risk-free rate, beta, market risk premium. Small changes in these assumptions can significantly change the cost of equity and thus the WACC. It's an estimate, not a precise number.
Well, that's all 25. We've covered a huge amount of ground, from Cotter's change steps right through to WACC.
We really have. Change management, people decisions, marketing, strategy, innovation, finance. It's basically a whirlwind tour of the core MBA toolkit.
And the idea is these tools give you a foundation for understanding and tackling business problems.
Exactly. And as Mark points out, they're often interconnected. You might use 5 forces to understand the industry, then the resource-based view to find your advantage, then blue ocean strategy to break out.
They work together.
Hopefully this deep dive gives listeners that foundational understanding, a starting point to explore the models that seem most relevant to their own challenges.
So maybe the final thought for everyone listening is this. Armed with this toolkit of MBA models, how might you look at your own business environment differently? What assumptions might you challenge now? What new questions could you ask?